Hello everyone, welcome back. In this video, we are going to study depreciation and disposal of a revalued asset. In the previous video, I have already explained the meaning of revaluation surplus. Okay, we saw how to calculate revaluation surplus in case of depreciable assets and non-depreciable assets. Okay, and we also did the journal entries and how to post them in ledgers, right? Now in this video, we are going to see how do we calculate depreciation on these revalued assets. Okay, so let's get started. First, I would like to tell you this using an example. Okay, so let us assume that we had a non-current asset of, let's say, $50,000. Okay, the residual value is 0 and its useful life is 10 years. Okay, and we calculate depreciation using straight line method. So the depreciation would be, put your formula over here, which is cost less residual value upon useful life. Okay, so depreciation would be 50,000 less 0 upon 10, which is 5,000. Okay, so this is our initial depreciation, right? Now what happens is, after 5 years, we have revalued our asset. And the value of our asset after revaluing is, let's say, it is $60,000. Okay, so what is the remaining useful life? Remaining useful life is, initially the life of the asset was 10 years and now 5 years have passed away. So less 5. So remaining useful life is 5 years. So now we will calculate depreciation on this new amount of 60,000 using our remaining useful life. Okay, I'll tell you once again. We had an asset of 50,000. Okay, we were depreciating it on straight line method for 10 years and that's why our depreciation was coming out to be 5,000. But now the asset is revalued to 60,000. Okay, so now depreciation would be calculated on this revalued amount of 60,000. And now since 5 years are left, so what would be the depreciation? The depreciation would be cost. Okay, still the residual value is 0 upon the remaining useful life, which is 5 years. Okay, so depreciation would come out to be 12,000. So see one thing, initially our depreciation was 5,000 and now it has increased to 12,000, right? Which means when we revalue our asset, the depreciation charge increases. This is because our numerator is increasing. Here the numerator was 50,000 and now here the numerator is 60,000. So that's why the depreciation charge has also increased, right? So let us study now. When a non-current asset has been revalued, the charge for depreciation should be based on revalued amount, like we did here. Okay, we calculate depreciation using this revalued amount and the remaining useful life of the asset at that date. The remaining useful life was 5 years. This charge will be higher than depreciation prior to revaluation and will be charged to profit and loss as normal. Okay, so we used to take depreciation to profit and loss account. Still, we will take it there only. Okay. So, IA 16 states that if an item of property, plant and equipment is revalued, the entire class of property, plant and equipment to which that asset belongs must be revalued. Okay. So, let us suppose that this was a land. Okay. So, I should revalue all my lands. Okay. So, this is saying that if you revalue one revalue one item of property, plant and equipment, so that property, plant and equipment to which group it belongs, you have to revalue that entire group. Okay, so even if you didn't understand it, it's okay. Just these 2 points were main. It only says that you have to revalue the entire class of PPE to which that asset belongs, right? Now let's move forward. Now understand this. This is something known as transferring of revaluation surplus to retained earnings. So first thing which you should understand this, that this is optional and this depends upon the company if they want to make this transfer or not. Okay, this is completely option. If they want, they can make the transfer, otherwise they will not make the transfer. Okay, so now let us assume that they have chosen to make this transfer from revaluation to retained earning. Okay, we will study what is the meaning of this, but first understand this, that company has decided to make transfer from revaluation surplus to retained earning. So the company has to make this transfer every year. Okay, it cannot happen that in few years the company is making this transfer, but in coming years it is not. Okay, so once it has chosen to make this transfer, this should be done on every year, right? Now let us understand what is this transferring. Okay, see, we are transferring excess depreciation. What are we transferring? Excess depreciation. I just showed you that initially our depreciation was 5,000, right? But now it is coming out to be, just a second. Mhm. Yeah. So initially our depreciation charge was 15,000, but now it is 12,000. So what is the excess depreciation? Excess depreciation is 12,000 less 5,000, which is 6,000. So this excess depreciation we are transferring from revaluation surplus to retained earnings. Now let us try to understand why we are doing this. Okay, you should know the logic. So understand it carefully, listen to it carefully. Our depreciation is an expense, right? It is an expense for the company. So when we charge this expense, our profits decline. So when depreciation has increased, so our profits would decline further, okay? Because now we are charging extra depreciation because of revaluing this asset, right? So our depreciation expense is increasing, and because depreciation expense is increasing, our profits are declining, right? So now, don't you think that this depreciation is arising because of some unrealized gain? We have revalued the asset. That revaluation gain is unrealized because we are not getting any cash in our hand because of revaluing our asset. So that's why this is an unrealized gain. So the depreciation which we are charging on the asset is because of an unrealized gain. Okay, so we are just unnecessarily reducing our profits, which is leading to understatement of profits in our statement of profit and loss. So, in order to prevent this understatement, what we do is we make a transfer from revaluation surplus to retained earnings. So, understand one thing, both these revaluation surplus and this retained earning has a credit balance. Okay, what balance do they have? They have a credit balance. We are just making the transfer from one plate to another plate. Okay, this is the plate of revaluation surplus and this is the plate of retained earning. We are only making the transfer. So when I will make transfer from revaluation surplus to retained earnings, my revaluation surplus would decline. Okay, in the balance of revaluation surplus is credit, so if it is declining I have to do the opposite, so that's why I will debit it. Okay, and I'm transferring it to retained earning, which means retained earnings are increasing. Okay, retained earnings have a credit balance, so if I have to increase them I will credit. Okay, so that's why my entry would be debit revaluation surplus and credit retained earnings. Okay, this is just a transfer in the equity section. Both these items, the revaluation surplus and retained earnings, they are shown under equity section. Okay, so we are just making a transfer. It will have no impact. It will have no impact on profits of a company, right? Okay, I hope it is clear. Even if it is not clear, so just understand that if it is given in the question that you have to make a transfer, so you will pass this entry debit revaluation surplus and credit retained earnings, and the amount here would be the excess depreciation, right? So that's it. You can read this. Okay, I've told you everything which is written over here. One more thing which you should know, that what is retained earnings. Okay, so retained earnings are the profits which I have not distributed to my shareholders. Okay, these are the undistributed profits that I have kept in my company. Okay, these can be used for the purpose of growth or for any purpose. Okay, so these are just the profits which are not distributed to the shareholders, right? So let's move on to doing this illustration. First, I'll clear this mess a bit so that I can write. Okay, let's start. A Storkic company owns a retail unit in central Springfield. It bought the property 25 years ago for $1 lakh. Okay, so the value of property is $1 lakh and it was bought 25 years ago and it has a total useful life of 50 years. Okay, so the timeline is like this. Okay, the total useful life is 50 years and we are standing when 25 years have passed. Okay, so these are 25 years and these are 25 years. They are trying to say this thing. Okay, at the start of 20x6, a historic company decided to revalue the unit to 8 lakhs. So what is happening? The property had an initial value of $1 lakh and now it is being revalued to 8 lakhs. So the increase in non-current asset is 8 lakhs less 1 lakh, which is 7 lakh. Okay, and because it is a property, it is a piece of land, so there would be no depreciation. Okay, there would be no depreciation. The unit has remaining useful life of 25 years at the date of revaluation. So see, now we will calculate our depreciation on this 8 lakh and using this 25 years. It is the historic company's policy to make annual transfer. Okay, so I told you that it would be given in the question if you have to make the transfer or not. Okay, so it is given that they make a transfer from make an annual transfer of excess depreciation between revaluation surplus and retained earning. So now we have to pass accounting entries. Okay, so the first accounting entry which we will pass is of revaluation. Okay, so see how it would be done. I'll write over here. Let me adjust it first. Yeah. All right, see. So first let us pass the journal entry for revaluation. So my entry would be, because the value of my property is increasing, so I will debit property, right? And now I will also debit accumulated depreciation. And I will credit revaluation surplus. If you don't know how this entry is made, please watch the previous video. I have explained over there. So see, how do we calculate the value of our revaluation surplus? Our revaluation surplus is revalued amount less the carrying amount. The revalued amount, we have revalued it to 8 lakhs. But what was the carrying amount? Carrying amount is cost less depreciation. So let us first calculate the depreciation. The cost of the asset was 1 lakh and its useful life was 50 years. So when you will calculate, the answer would come out to be $2,000. This was depreciation for 1 year, but now we are revaluing it after 25 years. Okay, so the accumulated depreciation for 25 years. If depreciation for 1 year is 2,000, so depreciation for 25 years would be 2,000 multiplied by 25,000, which is $50,000. Okay, so this is the carrying amount of your asset. So from here, deduct 50,000. So 8 lakhs less 50,000 is 7 lakhs 50,000. Okay, so here in the revaluation surplus, you will write 7,50,000. Accumulated depreciation, I have just calculated 50,000, and property, it is revalued to 8 lakhs, and it was originally purchased for 1 lakhs. So then amount here would be 7 lakhs. Okay, you can also calculate it as balancing figure. Okay, so this is the first entry which I have made. Now the second entry which I have to pass is of excess depreciation, because we have seen that it is the company's policy to revalue their assets, right? Sorry, it is the company's policy to make the transfer. So let's see how this transfer would be made and what would be the entry. The entry is debit revaluation surplus, because revaluation surplus is being reduced, and credit retained earnings, and this is by the amount of excess depreciation. We know the previous depreciation is of $2,000, but now let us calculate the new depreciation. New depreciation is the new amount, which is 8 lakhs. Okay, so 8 lakh divided by remaining useful life, which is 25. So 8 lakh divided by 25. Calculate this. So 8 lakhs divided by 25. This is 32,000. So excess depreciation, what is the extra depreciation? Earlier it was 2,000, but now it is 32,000. So the extra depreciation is 30,000. So here you will write 30,000. Okay, so these are your two journal entries. First is of revaluing and second is of making the transfer, right? Now let's move forward. The next topic is disposal of a revalued asset. Yeah. So see, now you have revalued an asset, but now you are going to dispose it off, which means you are going to sell it. So see, when you will sell the asset, the revaluation surplus which you have made till date that revaluation surplus was unrealized, because you were not actually receiving any cash for this increase in value. But now when you will sell this asset to which the revaluation surplus related, so now this revaluation surplus would be finally realized. Okay, upon disposal, this revaluation surplus would be finally realized, because now we are selling the asset. So that's why we would make the entry debit revaluation surplus and credit retained earning. Okay, see, first let's read this a bit. The gain or loss arising from re-recognition of an item of property, plant, and equipment shall be determined as the difference between the net disposal proceeds and the carrying amount. I will tell you this. Suppose, let us take an example, that you sold your property, the selling proceeds were 50,000, and the day on which you sold your asset, on that day the carrying amount was, let's say, $30,000. So clearly you have made a gain, because that property or that equipment had a value of 30,000, but you sold it for much more. You sold it at a higher price. So that's why it is a profit. The formula for profit is selling price minus the cost price, or in our case, it is the carrying amount. So you will have a profit of 50,000 less 30,000, which is 20,000. So in this way, we calculate profit or loss. Okay. If our selling proceeds are less, but carrying amount is more, then in that case, it would be a loss, right? Additionally, IAS 16 says that revaluation surplus included in equity in respect of an item of PPE may be transferred directly to retained earning when asset is derecognized. Okay, now we are selling the asset, so we will derecognize it, which means we will remove it from our books now. Okay, because we do not have this asset anymore, right? This is achieved by taking the balance of revaluation surplus account and transferring it to retained earning, which contains only realized gains. Okay, so this retained earning has realized gains. Okay, the gains which we have actually made. Okay, in cash, the gains which we have made. So that's why now the asset has been sold. So we have realized it. So that's why we are transferring it to retained earnings. If the entity no longer owns the asset because it has been disposed of, it is inappropriate to maintain revaluation surplus. Obviously, this is very logical. Now you do not own that asset, then why to maintain revaluation surplus, right? Hmm. Any balance on revaluation surplus on disposal date has now been realized, see, and should be transferred to retained earnings. Okay. So this is the journal entry, the same which we did above of excess depreciation. There also we were making a transfer from revaluation surplus to retained earnings. Now let's do this test your understanding to clear our concepts. And this is the last question for the day. Okay. Tiger Trees owns and runs a golf club. Some years ago, TT purchased land next to existing course with the intention of creating a smaller 9-hole course. Okay. The cost of the land was 2,60,000. Over time, TT had revalued to 6 lakhs. Okay. So because this is a land, so it is non-depreciable. That's why they have not given any information related to the useful life or the depreciation charge. So the first entry which we would make, they are asking us for the accounting entries. So let me write over here. The first entry which I will make is for revaluation. And it would be quite simple because it is a non-depreciable asset. So there would be no accumulated depreciation because my land is increasing. So I will debit land and I will create a revaluation surplus. Revaluation surplus has a credit balance. I will take the difference, revalued amount less the carrying amount, which is 2,60,000 only. So 6 lakhs less 2,60,000. This would be 3,40,000. So the first entry is this. Right? TT has now decided that building the new course is uneconomic and has sold the land. So now first it has purchased the land, then it revalued it, and now it is being sold. So let us make the entry for selling. So see, when you sell something, when you will sell something, what would come in? Cash would come in, or you can say bank if you are taking the proceeds via bank. So cash would come in, okay? And now what is going out? The land is going out. So the land is our asset which has, see, land is an asset which has a debit balance, but now since we are selling it, so we have to remove it. So I will do the opposite here of credit. Okay, so see how much cash am I getting? I am getting 6,95,000 of cash. Okay, and the land was worth 6 lakh. Okay, this is the new value, 6 lakhs. So tell me, the sale proceeds are higher than the carrying amount, right? Carrying amount is lower and sale proceeds are higher. So clearly it means that there is a gain and gains have a credit balance. So I will write over here gain. Okay. So it would come out to be the balancing figure 6,95,000 less 6 lakh, which is 95,000. Okay, so two entries I have made. First is of revaluation and second is of selling. Now, one additional thing, when we sell the asset, what do we have to do? We have to transfer this revaluation surplus to retained earnings, right? So just pass that final entry. I'm writing over here. So debit revaluation surplus because it has a credit balance, but now I am removing it. So I will write debit revaluation surplus. And what will you credit? You will credit retained earnings because finally you are realizing this revaluation surplus. So revaluation surplus was worth 3,40,000. So make this transfer. Okay, so these were the three entries. First of revaluing, then of selling, and then third finally of making the transfer. Okay, you can also show them in ledgers in this T form. Okay, you can make revaluation account, you can make disposal account. But these are the entries which you should know. Okay, and they ask for accounting entries only. Okay. So yeah, that's it for this video. I hope it is clear that how do we calculate depreciation? Okay, then how do we make the transfer? Why do we make the transfer? And finally, how do we dispose the assets? Still, if you have some doubts, you can ask in the comment section below. Thanks for watching.